Ever heard of an investment that promised guaranteed returns, seemed completely safe, and then vanished into thin air? That's exactly what happened in 2013, shaking the Indian financial market to its core. This is the story of the National Spot Exchange Limited, or NSEL, and a massive 600 crore rupee scam. So, what was NSEL? It was an exchange, just like a stock exchange, but for commodities. Think of things like agricultural products, metals, and so on. The idea was simple. It allowed traders to buy and sell these goods. But NSEL introduced a unique product. They offered contracts where you could buy a commodity today and sell it back after a certain period, say 25 to 35 days, for a slightly higher price. This promised a fixed, attractive return of around 12 to 14% per year. It sounded like a fantastic deal, way better than a bank deposit, and supposedly very low risk because every transaction was backed by actual goods, stored in a warehouse. Thousands of investors, from small retail players to large corporations, poured their money in, believing their investment was secure. For a while, everything seemed to be running smoothly. Investors were getting their promised returns, and the trading volumes on the exchange grew bigger and bigger. But in July 2013, the music suddenly stopped. The government discovered that NSEL was allowing something it shouldn't have. See, a spot exchange is meant for immediate delivery of goods. By offering these longer-term contracts, NSEL was essentially operating like a futures exchange, which requires a different, much stricter license that it didn't have. The authorities ordered NSEL to stop launching new contracts and settle all existing ones immediately. This is when the whole house of cards came crashing down. When NSEL tried to settle the contracts, meaning they tried to sell the goods in the warehouses to pay back the investors, a horrifying truth emerged. The goods simply weren't there. The warehouse receipts, the pieces of paper that were supposed to prove ownership of the commodities, were largely fake. It turned out that a group of 20 borrowers had been colluding with officials at the exchange. They were taking money from investors, pretending to buy commodities. But in reality, the warehouses were mostly empty. They were just recycling the money, using new investor funds to pay off old investors. A classic Ponzi scheme. The fallout was catastrophic. Over 13,000 investors lost their life savings. The amount involved was a staggering 600 crore rupees. Investigations were launched. Arrests were made, including the founder Jignesh Shah and other top officials of the exchange. The legal battles have been going on for years, with authorities trying to recover the money by seizing the assets of the defaulters. But for many investors, the recovery has been slow and painful. The NSEL scam served as a huge wake-up call for both investors and regulators. It highlighted major loopholes in the system and the dangers of investing in products without fully understanding the risks. It's a powerful reminder that if an investment sounds too good to be true, it probably is. Always do your due diligence and be careful where you put your hard-earned money. What do you think could have been done to prevent this? Let me know in the comments below. Thanks for watching, and if you found this informative, please like the video and subscribe for more deep dives into financial history.